Welcome and good afternoon to episode 7 of DX Digital Transformation Leaders 2021. We have a fantastic episode for you today with even more amazing guests and experts. Today's topic is conquering the next frontier in financial services, and we'll look into digital exchanges and digital assets. So it's a big topic. It sounds a little bit like Spanish for some, but we'll bring some sense, context, and relevance to the topic. My name is Lars Föder, storyteller at heart, and together with our co-host as every episode since last year, Andreas Anderlin from Hugo Capital Partners. Andreas, how are you doing today?
I'm doing very well, thank you. Just as a reminder, this is the last episode for this year, so that's a clear sign that this year is drawing to an end.
Well, you know, in some cultures, 7 is not the best of all luck numbers, but it's like there are some stories about the wild 7 bandits of the West. So let's take it as that. We are the wild bandits of the West, or East rather today, because this one is out of Singapore, for all of Southeast Asia. And we have some of the thought leaders, business leaders, and most brilliant minds on this topic here with us today. But before we dive in, Andreas, this is the last episode. So what's left for this year on DX Leaders?
Well, thank you. There is actually left a lot. So my name is Andreas. I'm the chairman of the Digital Transformation Award, and that's actually also the reason why we're here, because this DX leader is actually part of this Digital Transformation Award. So maybe Clarissa, if you be so kind, just to, and I'm not gonna spend a lot of time, but just give some context where we stand with this Digital Transformation Award. So as you can see here, we are very lucky to have different subcategories. And I think the main difference that we had this year is really about that we were expanding into ASEAN. And that's very important for the award, because we want to cover as much as possible in terms of ground, in terms of reach to our people and experts. So that's really a big change. And we can also see we have some very interesting subcategories, cyber. We have also financial services. Obviously, we're going to talk a lot about that today. And we have the support of our esteemed, sponsors. And we're very happy to have them. Without them, this would have not been possible. So big thank you out to our sponsors. All right, so let's go one further, Clarissa. Just to give you a sense where we stand, so it's not over yet. The best is yet to come, sort of. So 9th of December is the final pitching night. So if you're out there, if you have no plans on December 9th, tune in. It's going to be very interesting to see these contestants. We had our pre-selection, so we went through the subcategory public pitching this week and last week, and now you will have the crème de la crème sort of during this December 9th, where we will have the final winner. So please sign up if you're interested in understanding what's happening in Southeast Asia in terms of digital transformation. All right, one further. Yeah, and that's the invite for you officially here in front of you. Please scan in your the code. This will bring you directly to the sign up page, and we look forward to having you on the 9th of December. Thank you very much. And with this, back to Lars.
Yeah, just one small correction. Andrea said, if you have no other plans, I would actually reframe it as, if you have other plans, then joining Swisscham's Business Excellence Awards Night on December 9th, change them immediately, make that one call that can change your life, because you have brilliant minds, brilliant ideas, and you will see who will take away the crown of DX Leaders 2021. So there shouldn't be any other options actually out there.
Right, you're right, Lars. As always, you're right.
Good. So just a brief introduction of our fantastic panelists today. Then we run the poll, and then we'll start with the panel discussion. And a reminder for all our audience members out there, please post your questions in the Q&A functions, not the chat function, the Q&A function, so that we can answer them quickly, early. And if you don't have a question, but you like one, you can vote it upvote it. Please don't wait until the last minute. Nearly every episode, we're running out of time at the end of the day to answer your questions, because this kind of webinars and forums and panels are really about you to having a forum to learn, to listen, to share, and to ask questions. So do that early, please. So I'm very happy that we have today 3 experts. We have Thomas Seeb, the global head, exchanges and chairman of SIX. Thomas, how are you doing today?
Very well, thank you very much.
Where are you calling in from? It looks like you're out of space. And that's how it seems like for some people on digital exchanges, what it means.
I'm sitting in the snow in Zurich.
Some people will envy you. I'm sure you would love some tropical sun, right?
That's about it, yes.
Good. Then we have Fernando Vasquez, the CEO of SBI Digital Assets and SBI Digital Trust. Fernando, how are you doing?
Fine, thank you. Thank you for having me.
That's not, the white in the back is not snow, right?
Not really. It's a boring office. So,
so let's make sure that independent of the office, we have exciting things to discuss. And last but not least, we have John Dean, the CEO of Trovio. John, how are you doing today?
Good, thanks, Lars, and thanks for having us.
Are you the only one in the office? Is it?
Yeah, it's 8 o'clock at night down here in Sydney, so a lot of people have headed home for the day.
Thanks for making time for us all over the world where you are today. Let's kick the discussion just briefly off, involve the audience with our poll question on the future of digital financial services. So can we fire up the poll? What do you think are the biggest advantages that the future of digital financial services will bring? Is it volatility management, managing custody and risks, or concerns around the source of funds and source of wealth? Andreas, if you would have to make a pick, what would it be?
Well, you know, it's difficult to kind of isolate one answer, but obviously we would have, right? So I think, you know, managing custody and risk is really something that is going to be transformational. So I think that's really where the big change can happen. And the other topics, you know, that's just, you know, issues or concerns that needs to be addressed by the regulatory bodies. So
okay, let's think. Let's see what the audience thinks. Let's close the poll. Let's have a quick look and see if you were right with your prediction. You normally have a 50-50 on that one. Managing custody and risk, and you got it right. I can call you the Oracle from now on forward. Yeah, Andreas the Oracle, Endelin. That sounds better.
Please not.
Good. Okay, then with no further ado, let's move into an introduction on the topic with Thomas. Thomas, are you surprised by the choosing of the audience, by the result?
No, not really. It's fairly even, actually. And my answer to it, if I could have voted, would have been D, all of the above. So to that extent is not a surprise at all. It addresses all 3 issues and a whole lot more. So the fact that it was a fairly even distribution is consistent with that.
Okay, so you are the global head exchanges and chairman of SIX. So that means you are responsible for all of Switzerland's and Spain's stock exchange capabilities, correct?
Not quite. I'm responsible for all of the stock exchange capabilities. I'm chairman of SDX, but I'm not chairman of SIX. It's the group.
Ah, okay.
As a bigger chairman.
Okay.
My boss.
Okay. So today we're focusing mainly on the SIX digital exchange. So with that background, and I know you've worked all over the world, New York, London, Luxembourg, you name it, you've been there. So now it's a next frontier kind of thing. So what's your take on the topic to kick the discussion off?
I think let's take half a step back and provide a context. About 4 or 5 years ago, and I believe it was at a Cybos event, I can't remember, it was 2016 or 2017, the issue of DLT really came to the fore off the back of cryptocurrencies starting their first real big push up. And the talk at the time by the DLT, or by the blockchain evangelists, was that all intermediaries would become unnecessary and we would have a fully democratized infrastructure that allowed for getting rid of all these different evil layers in between. Clearly that has not happened, at least not yet. Even if we buy into that notion, there's no path from how we get from here to that utopian point. And I think what we need to do is really break this down into the two elements that are relevant. The one is the distributed ledger technology that has a lot of benefits. And the other is the issue of tokenization of assets, which also has benefits. The two are not the same, but they fit very well together and are generally lumped together in one hat. And that misses the point a little bit in terms of how do we now define where the benefits are? Because as always in these things, if we're talking about the same terminology, but our mental definition is a different one, then we're not talking about the same thing. From a SIX point of view, we recognized 3 years ago clearly that there were the both elements, the technology and the tokenization, have some real potential benefits long term. And so we built the SDX, the SIX Digital Exchange, which has been licensed now a few months ago. We also launched a number of crypto-based indices through our financial information group, and we've done the first bond issue, tokenized bond issue in a full FMI regulated structure just this week. So that process is now in place. People understand it. We now have the chance that in particular institutional investors can become more comfortable with the structures, and that they're being done in a way that is not unfamiliar to most institutional investors in the traditional space. In other words, you have a custody and asset servicing element, you have a trading element that you don't necessarily have to fold them together. You can trade cryptos or other digital assets wherever you want to trade them, and decide where to put the custody and be sure that the assets are segregated and the various transaction monitoring and everything else is done as one has become comfortable with since the crash of '87 in the traditional markets. So what we're trying to do at the moment is to build that bridge in two ways. The first way is traditional markets into digital, and we still all have a lot to learn. The regulators have a lot to learn. We're working with them, but also building the bridge between Europe and Asia through the joint venture that we've done with SBI, and Fernando can talk more about that as well, to build an Asia digital exchange out of Singapore. By linking ADX and SDX in Europe, we create a global liquidity pool that will allow anyone entering either from the Asian side or from the European side, and at some point potentially out of the United States, a single pool of liquidity rather than having to have separate links to different exchanges around the world. That is tremendously exciting in terms of ensuring that there's fungibility and liquidity between Europe and Asia, but also within the system as a whole that then others can tap into and set up nodes on. So it's a very exciting prospect. Our board took a clear strategic view on this 3 years ago and said, look, we see this as a future. It will at some point replace traditional structures of stock exchange, central counterparty, and central securities depository, but you can't force it. There's no point trying to force it. Banks and broker dealers and other intermediaries have to have the time to work through their own legacy platforms to get there over time. And in the meantime, we're looking to load more product onto the platform. So there's a little bit of a context as to the development from our point of view. Clearly, there are a number of other developments, some more focused on crypto, some more focused on other geographic areas. And that's part of what we're trying to do now in terms of linking into other networks as well.
Okay. Well, Tom, thank you very much for that context. And I think that that was very helpful for all of us to put your role and your role as the chairman of Six Exchange also into context. So, I mean, we had some really significant changes in, in the previous months, right? We had China crackdown on digital currencies. We now also have India, that is reinforcing their regulatory efforts. We have, Coinbase going public. Then you have this whole retail movement that has been also quite significant. So what would you describe as the key trend in the last couple of months? Because there were a lot of changes in the whole environment. What would be the key trend for you that will change the future of this digital asset space?
Well, everything you've described is related to crypto, right? Not other digital assets where you have a digital IPO or an STO done.
Yeah.
And in that context, in the crypto context, what we're seeing now is a degree of discomfort on the part of regulators and policymakers with what is perceived to be a lack of controls and a lack of transparency in terms of what is happening with these assets. That's one of the issues we're trying to address by having a fully licensed infrastructure. I think we have to be clear that what has developed coming out of that retail push and demand is a network of capabilities around cryptocurrencies that in the institutional space would not be particularly appealing over the long term. And the reasons are clear. For instance, if you buy Bitcoin at one of these exchanges, then they are, unless you take it out in cold storage, they are your custodian. That's what we used to call in the traditional world broker custody, which effectively meant that if I bought shares of a company through a certain broker, he was my custodian for those shares. If there was an event like October 87, and a lot of brokers went belly up, then there was a big question mark what happened to my shares. And as a result of that, that whole global custody movement started where you had independent custodians like State Street and JP Morgan or Chase at the time, Bank of New York and so on, saying, look, you can hold these assets separately from where you're trading, and we will segregate proprietary from client assets, and we'll do all this good stuff. That is the next level of maturity that we really need to get to for regulators and policymakers to feel comfortable with crypto. It's got a bad reputation. Some of it deserved, some of it not. And I think it behooves us as infrastructure providers and market participants to find a way to get regulators more comfortable with that asset class, and in particular, how it is being administered once the demand for the trade has actually been executed.
Okay, thank you, Thomas. Maybe let's move it over to Fernando. You were mentioning him just now, who has over 20 years of very diverse experience, how I understand it, in open software development, contributed to commercial use of Linux kernels. So yeah. I get the topics, but what I understand is you're really an expert on the computer, on the programming, on the digital side before DLTs existed. Is that a good summary?
Yeah, I'm the geek in the call. I'm the geek in this
You're
call.
the geek. I didn't want to call you out on that, so thanks for doing that for me. So with where we're coming from and what we just discussed with Thomas, can you share a little bit on how does open space, and now we're getting a little bit technical, but maybe we can keep it with a viewpoint from a business point of view, is something like open space blockchain technology. So we're going into the technical side now, helping to achieve what we just discussed. So liquid assets, market efficiency, or is it something else? Because open source was not necessarily what built existing traditional markets, right?
Yep. Yeah, absolutely. And before getting to that, let me make one comment about what Tom just said. So even in the open source space in the early 90s, right? A few of us, right, the so-called open source jet set, we thought that open source was going to kind of be the king of the hill, that we didn't need the IBMs and Microsofts of the world, right? But you see now, right, who's making the most contributions to open source projects, and you have Microsoft itself, and you have IBM, Intel, right? All these non-sexy shops, right? And why? Because sometimes when you want to make something mainstream, you need to do that change from the inside, right? Otherwise, it's not going to happen, because these entities have an asset that is really valuable, which is trust. And that is something that SIX has, something that SBI has, and many other incumbents willing to disrupt themselves have, right? And I think we shouldn't underestimate that. And also on the regulatory side, I honestly think that even though some people are calling these headwinds, regulatory headwinds, I think it's a good thing that we got the regulators' attention, right? Now find a good position to make the changes that are needed to regulations and also business practices, right? To make all of these become mainstream. And going back to your question, right? I think it's not by chance that all the major blockchains, both private and public, chose some type of open source license for the projects. Today you have Bitcoin, you have Ethereum, Cardano, Solana, Corda, Hyperledger, you name it. All of them are telling you that they're going to be the winner, right, of this so-called blockchain revolution. But I think what's going to determine who the winner or winners will be is whether you're able to build a vibrant and healthy community around it. And there are many stakeholders here. You have banks, you have regulators, you have investors. But as it happens with most disruptive innovations, right, especially those that are driven by technology, building a global developer community is going to be key, which is why open source is like a natural choice. You try to keep everything proprietary and build up from there. Things would move too slowly. I mean, we wouldn't have the internet or the cloud if we took that approach. Again, all these big revolutions are based on open source project. That doesn't mean that there's going to be a single winner, right? I think there might be one or two per use case, one or two 45, another for payments, right? So I think we will see a lot of consolidation, but all of that built around open source. And I also think that the value proposition will be at the application level, right? At the end of the day, users want to use actual apps, actual services. It could be payments, it could be just getting loans, you name it. So this is a lesson that the telcos learned during the cloud revolution. They thought that by owning the plumbing, they want to run the show, right? But then you have the big, cloud providers who are making most of the, get the most of the profits and revenue. I do agree with you that, blockchain, and I think Tom also touched on that, it's an enabler, right, of things like tokenization, right? So now with the tooling that was built around blockchain, it's quite easy to tokenize, list and trade any asset class, both traditional and new. Maybe it's a bit too easy in some cases, right? People take shortcuts, or things like compliance might be an afterthought. But still, especially in the retail space, there's a lot of people kind of willing to take risks. But when it comes to institutional clients, right, they are asking for more. I mean, custody is something that we have already discussed. And a big part of that is going to be also identity. Tom said, building global custody, global liquidity pool is going to be key, but having global CSD, central security depository, for all the relevant asset classes, and even being able to do the onboarding in Japan and Switzerland, Singapore, you name it, and be able to share that KYC information between jurisdictions, that's going to be the key, differentiator, right? Once we get there, we'll have finally actual global markets. Today, there's so much friction. Even you open a bank account with a bank here in Japan, I go to subsidiary in Singapore, I need to redo the whole thing from scratch, right? So again, the technology is an enabler, It's good to get things done pretty quickly, but regulation is kind of lagging technology by far, right? And some people, again, it took too many shortcuts, and so that's why some people don't like what they see in the market. They find it a bit scary. But I think big players like SIX, SDX, and SBI are trying to change that. And not only that, right? You see big institutions, right, kind of getting involved in this space, right? And now what we saw in open source back in the late 90s, early 2000s is going to happen in also in digital asset space. I really see the big names, the boring, not sexy players, kind of leading the way. I know some people might feel things otherwise, but I think that we have this trust component. This an asset that is not easy to, you cannot just get overnight, right? So I think that's going to be one of the key differentiator. And here to say that as a former geek, I honestly think that this trust component is something that is going to be needed, right, to make all of this mainstream.
So then maybe just one follow-up question on the trust. There's an old saying in the IT world: nobody ever got fired for buying IBM. It's not the sexiest, it's not necessarily the best or cheapest technology in the market, but it's proven and it works. So how do you make sure that in this massive kind of leap that especially institutional investors that are extremely risk averse normally when it comes to technology, how do we make sure that it's two things? That we have kind of a standard, we don't want endless battles of VHS against better again.
Yep.
Second, that they really trust the technology and it goes beyond sandboxing and trials to look sexy.
That's a really good question. And I would say that more than technology itself is a governance issue. And let's say if something breaks at 2 a.m. on Saturday night, right? You cannot go and blame the Bitcoin community or Ethereum community. Oh, sorry, the community had an issue. That's not the way it works, right? Obviously, that's not going to happen, right? So, and I think we need to have governance and network in place that recognizes the fact there are many stakeholders in this community. And some people, and especially in blockchain space, they tend to think that the only stakeholder are the token owners or coin owners. That's not the case. You have actual users, you have investors, you have issuers, you have regulators, you have the Ministry of Finance, the central banks, and you name it. So I think we should move towards multi-stakeholder governance model, which is what they have in the internet. The plumbing is the same everywhere, but we have like what we call autonomous systems. I mean, in Japan, in Singapore, in Switzerland, you name it. And if something breaks in Switzerland or Japan, the internet is still working, right? And if you're under attack from an unnamed country, right, and you want to leave out of the network, you can do so, right? But we are not quite there yet. That said, I see that many of the big projects like Ethereum, Solana, Cardano, setting up these foundations. Right, have the Ethereum Foundation, Solana Foundation, Cardano, you name it. And you see that they start to engage, right, with all the different stakeholders, not just with token and coin holders, right? And once whoever is able to build this multi-stakeholder governance framework, I think it's going to be one of the winners, honestly. It's more than technology, it's about giving assurances to the users of that technology that there's a proper governance in place and there are checks and balances, and that someone is liable. And
this governance obviously, is contradictory to the essence of the technology, right? Because I mean, it's decentralized, and there is a kind of inherent, a constellation with this distribution ledger technology that is actually hindering the governance, right? But that's maybe something we can talk a bit also later on security and all these topics. So maybe I just want to go over to John, because he has a lot of experience in that area, right? And so John, I mean, what Fernando was talking about, these risks, I mean, you have a lot of experience in risk management over the course of your career. What would be your take on what Fernando was just mentioning?
Yeah, I think he's pretty spot on. I think in respect of what's going on, like we run a business which is both a technology business and an asset management business, okay? So to give some context to that, we license technology that interfaces directly with the commodity markets, ERP, CRM system, so nothing to do with blockchain, but provides a digital on-ramping for both digitization and tokenization. So exactly what Thomas was referring to in separating the two, and it's important to understand the difference. On the asset management side, though, we provide effectively digital asset management services. So in regards to your question, we have done a huge amount of work on the different types of risks and exposures you have for clients. And there's a whole new breadth of, I guess, new risks when you go into a fund that investors really need to be aware of. You know, traditionally people look at it from a market risk, operational risk, potentially regulatory risk, right, which is generally very low unless you're playing in emerging markets. But when you look at, you know, crypto as an asset class to invest in, you know, there's really a whole new risk, right? Technology, right? Technology risk is when you're doing anything across smart contracts, you need to truly understand about it. You need to understand composability risk. You need to understand, you know, who's the audit firm and whether they're a reputable audit firm if they're doing some sort of smart contracting auditing. So you're seeing a number of, I think, traditional funds try to launch crypto strategies, and I actually think it's somewhat risky because I don't think they have the in-house expertise to understand some of these new emerging risks. The other part of this is the regulatory risk. You know, there's heightened regulatory risk in this space. You know, it's not just you know, how tokens are issued, right? It's what they're actually doing. Are they privacy tokens? Are they going to have some sort of issue down the track? Is there going to be an SEC investigation? What's backing USDT? All these sorts of things arise, and I think there needs to be pretty reasonable amount of oversight for anyone who wants to participate in a fund structure. In regards to the the overall ecosystem, and I guess maybe more of a technology answer on blockchain in general, but you know, something like Ethereum versus more of the emerging, I guess, smart contract or layer one solutions obviously go from centralized to decentralized. You can argue that, you know, Ethereum is the most decentralized in that sort of layer one solution. There is a risk in that process, right? I mean, they're weaker at the start to when they get to the end, you know, from a decentralization standpoint. And that's, you know, a lot of people like to speculate, you know, on these, call them penny stocks. It's kind of like going, you know, in exploration type companies in the mining sector, if you want to sort of refer to historical booms. And that's what I think you generally see from a risk perspective, from an investor standpoint. And then lastly, I'd add, you know, we've touched on the custody side of these assets. I actually think the custody journey is a lot further than, you know, people keeping assets on exchanges. I think, you know, there's a number of very reputable custodians out there. We launched a fund in January 2018, and the custody options in 2018 were limited at best. You know, we used, I think, Kingdom Trust at the time. Now you've got, you know, mainstream custodians everywhere, you know, whether it's Fidelity, whether it's obviously, you know, Coinbase listed on NASDAQ, you know, you've got OSL up here in Hong Kong. You've got a number of really reputable solutions if you want to hold it in cold storage. But then the next question is, well, what about if you want to do something around DeFi, you know, yield farming, staking? Well, then you need a different custody solution like a warm wallet, and you're probably, you know, operating with people like Fireblocks. But our experience with the institutional market, I think, is slightly different to maybe what Fernando and Thomas were referring to. I think the institutional market's actually probably further down the curve in regards to this asset class and from an adoption standpoint, and realizing that you do need other types of service providers, and those service providers now have SOC 1, SOC 2 compliance, and these sorts of controls in place and audits in place to be coherent. And, you know, meet a certain level of standard. So I think we're getting there. We're not, you know, we're definitely not, you know, US equities or the bond market today, but, you know, obviously a lot of people are providing infrastructure to try and offer this service. And it's, you know, 2 to 3 years away still to being a mainstream asset. But I think we did switch 6 months ago, where it went sort of, it's nearly a career risk not to be involved.
So, I mean, we have been talking a lot about crypto, and I don't want to spend too much time then on crypto, but there is one burning question around security, right? And there is this inherent conflict of, you know, security, speed, and cost of the transaction, right? And so what is your, I mean, Fernando, maybe back to you, what is your a take on that? Because you have been thinking about security combined with AI for a lot of time, right? So how would you see that topic?
I mean, I think we should maybe take a step back, right? When you say security, there are like two different angles, right? One is securing the keys, that's one angle, and the other is fraud, right? Is the fact that in many cases you cannot easily identify who you are transacting with. That's usually an issue in the crypto space, right? And especially since with so many people doing self-custody, you're able to, take over someone else's phone with millions of dollars worth of crypto, then you make your day, right? So that's where we think that things like the big banks were doing traditional, like filtering and monitoring using, the Reuters database, the PEPs list, right? And doing transaction surveillance is not good enough. What we're actually doing ourselves is to basically connect the traditional world of compliance, AML, and CFT, you name it, with transaction monitoring, and also with the SOC, the Security Operations Center. So far, you had these three different silos, right? You had the SOC being able to identify whether one of your clients' phones has been hijacked, right? And they wouldn't tell the compliance team, or they wouldn't tell transaction monitoring, right? So because of this lack of coordination, there were many red flags that no one was even aware of, right? So what we've been working on for the last 2 years is to connect these three different worlds: IT, compliance, and trade surveillance. The issue with that is that when we did so, basically the monitoring team was a bit overwhelmed, right? Because you're supposed to monitor all of this in real time, especially after the FATF came with the travel rule and and these new regulations. And we try to take the traditional approach where define rules and see how that goes. But we found out that the bad guys are pretty smart, right? And word gets out about what people are doing with all the different rules. So it's quite easy to walk around those such checks, right? So what we've been doing is introduce AI to be able to do a pre-screening of all the different inputs. Otherwise, the back office risk management teams get overwhelmed. It was just too much information. And the issue that we have with that is that after, again, off the record, so I didn't say anything. So for the last half a year, actually, we found out that AI models were not quite working, right? Because the bad guys, they kind of changed their ways, right? So we found out that we had to retrain all the models over and over again, right? And that's why we had to change the model completely and move from traditional AI to what we call self-learning AI. So the models can train themselves. But it took us more than a year to come up with something that actually works, right? So that is kind of the background. I mean, when it comes to traditional key management, and now there's MPC, so it's like file blocks. In our case, we build our own, and I think there are pretty sophisticated solutions out there. It's more on the fraud detection, AML, CFT side of things that we need to make improvements, because the stakes are much higher than traditional finance, and that's why I think AI is going to play a big role. There are just too many inputs, right? Too many factors to take a rule-based approach.
Thank you, Fernando, from the more technical side, and also pointing out that there are so many moving parts that are constantly evolving. Let's move back maybe to the business side with Thomas. So let's put maybe crypto as one asset class aside, because overall we want to talk about also digital assets and tokenization. What other asset classes or adoptions and applications of tokenization do you really see taking off that need a different way of working on liquidity and these kind of things? Because technically REITs or special purpose vehicles all are kind of versions of investing into a certain asset class, breaking it down. The problem a lot of times was liquidity, and you couldn't trade these things. So from a business point of view, where do you see the real excitement in the market, institutional, for digital assets and tokenization in general, aside from crypto?
Well, it's still a market that has a long way to go in terms of growing, right? The issuers that we're speaking with now to load our platform, now that we have the licenses, run the gamut from straightforward small, medium-sized company equity capital raising. These are guys that otherwise would go to some kind of crowdfunding platform and maybe bulletin boards for some kind of liquidity capability. We can give them a platform that has the liquidity capabilities built in. Clearly, the more links we can provide to other networks around the world, the greater the access they would have, which they wouldn't have in a straight crowdfunding platform environment. So that's one side, that's sort of equity capital raising. Then you've mentioned a couple of possibilities around REITs and that sort of thing. Again, getting onto a proper exchange opens up opportunities for more liquidity. It doesn't guarantee it, right? We've got plenty of stuff on our traditional exchange that has very low liquidity, and we have various techniques for trying to increase that. But linking these activities that we're doing on the digital side, again, with other exchanges around the world and other networks, opens up a lot more opportunity for investors to get access to those securities. Specifically, what are we looking at? We're looking at bonds at the moment. Again, pretty much a traditional one, but for less liquid ones, there's opportunities there. We're looking at promissory notes and so on, things that have already been issued that now the issuer is looking for putting into a secondary market for trading purposes. We're seeing various financing tools in terms of trade finance tools that people want to see on the platform as well, so that they can syndicate it somewhat easier. So there's a wide range of activities. And then you have the usual things like art funds and that kind of stuff that is also looking to get out there. So we're going through a number of these at the moment to see which ones make the most sense to bring onto the platform in what order.
So what's in your mind, your order? Sorry to call you out on that, but now I'm really curious.
There's not a simple answer to that, right? As Fernando has said, you know, tokenizing different types of assets is not that difficult. The question really is, and this is still back to straightforward traditional stock exchange activity, is the issuer ready? Do they know what they're getting themselves into? I mean, they still have to follow the same rules from a reporting point of view and so on. They're somewhat easier in the digital space, but certainly in our jurisdiction, there's still a hurdle you have to go through in terms of exchange regulation and so on. So is the issuer ready? And do we believe that we'll see a reasonable amount of secondary market trading in that security? So there are other factors at play rather than just, you know, what's the easiest one to bang onto the exchange? That's not the hurdle that we're looking at all.
Maybe out to the panel also, you know, because if we look beyond just the core financial markets, right? I mean, there are obviously topics around assets as a service, you know, where you kind of tokenize a machine, right? An investment into a machine, and retail investors can come in and actually get a share, a token in that machine, and are also rewarded on the returns of that machine if, you know, you have cash flow. So that's a very interesting model, how to also finance you know, capex investment into physical assets. I'm talking about machines, right, that are heavy upfront investment. And so, I mean, is this something that a bank would also look into and say, okay, well, that's an interesting model?
Can I maybe jump in on that one real quick?
Yeah.
Yeah, so we're actually looking at something very similar, but not on a machine, but on fractionalized owner-occupied home equity. So what that means, obviously, the custodian of a home, the one they live in, is obviously the owner, right? And the ability for people to use tokenization to take out trapped equity in their houses and use that capital, right, which they're able to extract for whatever purposes they may want to use it for. And why would you do this? Well, obviously, it's really like another way to securitize the assets, but do it on a mass scale, connected directly into the banks, right, which is already underway. and obviously allow them for whenever there is a sale of a house for that cash flow to form as nearly like a payment back to the token holder owning, a portfolio of millions and millions of houses spread, all over the USA in this instance. And so really from an investor standpoint, though, it's an alternative to a REIT, right? Like you're getting really a asset which is often the last asset to be sold on a downturn, because obviously they sell their boat, they sell their investment property, they sell their stock portfolio, but they don't sell the house they live in. So you have a lower drawdown in a downturn. The custodian, as I mentioned before, is the owner. But it also gives those investors access to an entirely new asset class, which in California is a $10 trillion asset class. So that sort of use case, I think it's untested yet whether it's going to work, but I think it's a really, really exciting space that could be hugely positive to the economy from unlocking that trapped capital, but also opening up new asset classes for investors all over the world.
Yeah, especially for retail investors, right? And so they get access to an asset class that they were never having access. And as I'm going back to Tom's statement, that this democratization, and I don't like the word, but it's everywhere, right? So I mean, how is that? How do you think about that when you think about the future of the financial industry? I mean, this is really, is it revolutionary or is it just a buzzword?
Yeah, I think it is. Andreas, so going back to your example, right, and the machine thing, that also applies actually to art and wine, you name it, right? You end up with the issue of provenance, right? You should be able to track the actual physical thing and do mapping, from the token and the actual physical thing. And at the end of the day, this is a type of identity, right? So we need to build up an identity framework that covers not only the participants in the network, but actually the assets themselves. How you do the mapping, right? And that is a big challenge. But again, the tokenization is in a way the easy part, but the fact that tokenization is easy doesn't mean that we need to lower the bar of entry, right? We should need to follow due process. And you want to sell a Picasso, right? There has to be someone that you trust, right, and that can guarantee that this token is representing an actual Picasso. No, something that has been counterfeited, right? So I think this is revolutionary, but also we come up with the new challenges, right? And business processes that are not quite there yet at the moment.
Okay.
Maybe a different angle to skin this cat today. The financial industry is always excited about new opportunities, but at the same time extremely risk averse. So going back at that kind of thing, right? So all of you, the open question, do you see a majority, and if we even can conclude that there's one financial industry, do you see there's more openness, excitement about what technology allows us with what things we can do that we couldn't do in the past? Or is there still a majority out there that kind of let's sit and wait. We have possibly more to lose than to gain. What's your overall feeling in the market? Or can't we even sum it up because it's so diverse from regulators to that? And people say, oh, we can't wait. We have to do it. Not our choice. It's the buyers at the end of the day. Who want to take a stab at that?
I can start. I think the groundswell is clear. Regulators don't have a choice, right? You just have to look at all of the markets. They're all grappling, and I come back to crypto in the first instance. They're all grappling with the fact that millions of people are buying Bitcoin. They're buying them not necessarily from reputable sources. They don't know what's going to happen if something goes wrong. But what is guaranteed is that the local government will be blamed. Why didn't you protect us? We see that in almost every single European country. So regulators have to deal with this issue. They have to think of a way to work with the industry to get there. I don't think any financial market intermediary firm can afford at the moment to just ignore it and say, let's wait and see. There are so many potential cost benefits to, in particular, tokenization, as well as the product benefits of new products with a low interest rate environment where people are looking for other things to invest in. You can't afford to ignore it. It is going at different speeds in different markets, clearly. but the conclusion is inevitable. It's not going to be something that sort of just goes on the back burner, and it's gathering momentum.
Thank you, Thomas. Fernando, your point of view on that?
Yeah, actually, adding to that, I think there is appetite, right, for new asset classes, right? And you saw that when NFT technology was ready, there was this huge boom, right? Some people call it a bubble, but there is a fact that there's demand for such new innovative products, right? But also feel that, you know, just look at the banks, right? The profit margins are going down and down. They see that there's this new demand, and again, look a bit scary. But I think that many of the big players, and they started to realize that there are ways of monetizing trust. That is an asset that most of these new players, or the so-called crypto natives, don't quite have, right? So what I think we are going to be seeing that in the next few years is the non-sexy players like us, right, get more involved here, because there are many different ways in which, you know, something like a trust can be monetized, right? My wife won't open an account with an unnamed crypto native shop, but she will be willing to do so if it were through one of the non-sexy traditional institutions, right? And the same applies to my parents, right, and my kids. So I think that we'll see that. It must sound counterintuitive, but you'll see this decentralized world, and then the more centralized entities have this trust component, and there's going to be like a marriage of those two worlds. So.
So you're more talking about this hybrid word, right? Sorry, yes. Sorry, Thomas. Yeah.
Sorry, Andreas, it's an important point. You know, a friend of mine is a senior fund manager at BlackRock, and I saw him a couple of months ago, and he said, we can't ignore this. Look at it. My mother in Portugal is asking me why shouldn't I be in Bitcoin? And you know, and that groundswell is there. You know, we have to deal with it. We have to find mechanisms for protecting people from themselves to a certain extent, and from bad decisions and from fraudsters, but not limit their access to freedom of investing where they want to invest, as long as they're doing it in a conscious fashion. But you know, we've got to that stage where you can't stop that anymore. You know, when somebody's 90-year-old mother is asking their son, who's, you know, who runs a multi-billion portfolio, why shouldn't I be in Bitcoin? You kind of have to take it seriously, because that's repeated thousands of times.
Yeah, but isn't that the same like what we saw in the late 90s, early 2000s with the first internet bubble, where everybody thought from the 15-year-old to the 19-year-old, they have to be in the next gen internet fund stocks. And the problem was not the technology.
It was the business model.
It was the business model.
Lars, I'd like to mention, now one of the biggest players in the cloud business is Microsoft.
Yeah. So maybe, you know, one burning question that maybe, you know, some of the people that are listening have, because there has been a lot of buzz around metaverse, right? So how do we put that into the context? Now, is a bank going to transact in the metaverse? Is that something that you envision, or is that something that is far off?
Can I go on that one, maybe? Can we just take one step back? You asked a question before around, you know, what these banks are doing. I think we're moving towards virtual marketplaces. Okay, so I think you're going to provide digital on-ramps for all assets, and all assets are going to effectively transact in virtual marketplaces, which will have all the regulatory framework, but will effectively form in some form of decentralized fashion and replace traditional marketplaces. And I think, you know, you're going to see it probably in spot FX and commodities to begin with, because it's the least regulated sort of place. In regards to the metaverse, I think it's unlikely that the banks are going to be playing in the metaverse, but you're obviously seeing people like Adidas and Snoop Dogg buying up land blocks in the sandbox, right? You're seeing a lot of brands buying up reasonable plots. Obviously, part of it's being done, you know, in partnership with people like Animoca Brands, which is obviously, you know, a big firm in the region. And I think that's largely obviously a marketing play on how the world's going to develop, and people are obviously eventually going to build office space and host meetings. We're personally building an office block in the metaverse, and we're going to host virtual meetings and, I think even from a ESG standpoint, you could argue that not having to get on a plane and fly around the world to meet people face to face, there could be some value in it. But to me, the metaverse is much, much more like the dot-com boom, right? Like right now, I think everyone is thinking it's the next big thing, and it's got a huge amount of enthusiasm on the back of Facebook renaming and rebranding itself to Meta. But it's much more of a high risk, high speculation transaction than someone buying Bitcoin today. That's how I sort of view it and think the world can operate. I think what's happening in DeFi is much further down the curve. And I think we're already building all of the rails and infrastructure to support that and the form of disruption that's going to be caused from it.
Yeah. So what's the key infrastructure? I mean, in terms of DeFi, is it Ether? Is it what kind of?
Well, I think Fernando made the point before about the ecosystem, right? And the ecosystem's important because you need to get people and stakeholders all engaged. And Solana is an interesting one for that because it's backed by FTX effectively through Sam Bankman-Fried. The Sam Bankman-Fried, is his own brand. Tom Brady is, he's sponsored by FTX. And so they are building up their own ecosystem. And you see the developers going on Solana, it's going at a rapid rate versus where Ethereum's at. But, Ethereum has a historic ecosystem that supports it. It's not easy just to shift, right? So to me, there is a layer one, competition, demand sort of push out there. But I think people like, which is silly, right? Because you're sort of talking about being decentralized, then you've got effectively a centralized body sort of pushing it. But, that sort of ecosystem, I think, would definitely put a lot of pressure on Ethereum. And then the last thing, obviously Ethereum's is expensive to transact on. Its gas fees are problematic. For anything one who wants to do small transaction, Ethereum's not a very, useful network. We actually issue tokens on the Ethereum blockchain, gold tokens, effectively tokenized gold. And, for people to transact in that, it's just, it's not that economical today, whereas you could use something like Phantom or Solana or Avalanche.
Maybe adding to that, I don't think that any of those chains have been able to fix the governance issue, right? They are not committing to any SLAs, right? And this is going to become really mainstream, right? And I really think we need to solve that issue. I mean, outages of hours or just a full day, which happened a few months back and to an unnamed chain, right, are just not acceptable, right? And so DeFi, I mean, it's kind of okay, right? But I think that we as an industry, we need to start tackling this governing issue. And I honestly think that's going to take a while.
You got to admit though, Fernando, like you do have stock exchanges go down for a day, right? There are outages on major exchanges that we sort of argue can operate 24/7. So yes, there's definitely issues in the governance structure, but it's not as if the current infrastructure is that much better.
Yeah. But is that also a case for closed systems? Like talking about the governance, right? On Ether, you also have closed systems where you have big players agreeing on a certain rule book and kind of doing a use case within a very closed system. Is that maybe the future to address the governance issue?
I mean, you see that work in the internet, right? And you have all these the ISPs, tier 1, tier 2, tier 3. Yes. And that's how this whole thing worked for a while, right? And then we came up with the AS, the autonomous systems, right? And now they can talk to each other directly without going through, the tier 1 ISPs because they are controlled by, US and Japanese entities, right? So even for the internet, it took us like almost 2 decades to figure it out. But as of today, you see that the internet is working, right? And the telcos and the others are actually committing to SLAs, right? And they are held liable. And as John pointed out, you see outages in the big exchanges, right? But if you call them, they can tell you in real time what's going on, right? And they might be able to maybe, indemnify you for that, or there might be insurance, right, to cover whatever, the financial loss you might have made during that time, right? So I think that's kind of the missing piece, right? Some people need someone to blame. That's one angle, but it's also the fact that you cannot base all the financial plumbing on a chain where there can be a fork and you have like factions fighting with each other, and then there's no agreement and there's too much uncertainty. You know what I mean? That's the kind of the side of things that we have not been able to figure out until now. And just one final comment. I think that what regulators are going to be regulating is the financial service that you're offering. It's not the tech. If you're offering loans through a DeFi solution, it should be that loan service that is regulated. It's not the tech under it, right? So that comes with the implications. And unless there's a proper governance in place, how do you regulate that if there's no governance? Who do you talk to, right? So I think that's the missing piece.
Thank you, Fernando. And I think you already kind of took half of my job away in summing it up where the debate stands, because I think we've come to an end. The time just ran past like faster than some transactions on the blockchain. So thank you very much, Fernando, Thomas, John, and all our listeners and the audience outside. Just some of the words that we shared today. So Fernando emphasized that it's not by chance that major blockchains have open source licenses, but the key component that we look beyond technology will be trust. I think that's something that we discussed to a long extent. And trust is the part that has to make it mainstream, and to achieve that we need first and foremost healthy governance structures that look at the wider stakeholder ecosystem. And then Thomas actually was building on that and sharing like, it's too far down the curve. We can't stop it anymore. If even the grandmother wants to do it, do we have the technology, the infrastructure, the governance, the trust that allows that person to do it safely, securely, in an environment where they can follow the investment choices they want to make? At the same time, Thomas also shared that digital assets still have a long way to go in terms of growing, but it's exciting to be at that part of the journey. And then we had John sharing, among many other interesting things, that institutional markets are further in the curve. What we need now are actually service providers. So, and I think that's the interesting discussion that we had today. Technology has certain aspects for there. We have service providers, we have regulators there, all coming together, bringing it there, because around the future, we need to focus on the securitization of assets, but this has to be done on mass scale, and this has to be connected to banks, the more traditional ecosystem, so that it's not kind of two parallel worlds, but those that can bring it together. I think that's where Thomas started today, thinking about explaining how SIX Digital Exchange brings two markets together for many, many advantages. But it's not just technology, it's many different things coming together. Well, I tried to summarize an hour in just 90 seconds. Not an easy task. So thank you very much, Fernando, Thomas, John. Thank you, SIX Group, for being the sponsor of today. Of course, thank you, SwissCham and Deloitte, to enabling the DX Leaders series. We are back on 9th of December. Whatever plans you have in your calendar, scrap them, because it's the DX Awards. Thank you very much. Any last words of wisdom from the Oracle, Andreas?
No, please. You just summarized it very well. Thank you all that joined in for your time, and we really appreciate that on behalf of the SwissCham to have all the experts here on this panel. So thank you very much, and see you on the 9th of December.
Thank you. Bye-bye.
Thank you for having us. All right, bye-bye.
Thank you.
Bye.